John, it's always great to see you. How are you?
I'm doing great, Becca. How about you?
Yeah, I'm good. It's sunny, isn't it?
Yeah,
Well, it's here in the UK,
it's
so it
summer.
makes such a change.
Yeah, I remember that when I lived in the Midwest, but I have sun most of the year now in the South. So
Yeah, show off.
yeah, that's right. It's one of the reasons I moved was to get more sunshine, not
Oh,
just
wow.
him.
I've just put my
Yeah.
holiday in with you then. Go You'll find me on your doorstep. Anyway, today we're gonna talk about selling businesses and preparing for sale, which for me is really interesting because A, that's something I'm working towards myself with my own business, but also, sort of colleagues and clients of mine are also looking to do that, and we're looking at ways to help them do that from our point of view. So I'm really fascinated to hear how you think, we should all prepare for selling our businesses eventually and
Mhm.
getting more than £10 for it, which would be nice. So, I mean, how long does it take to sell a business? When do you need to start thinking about it?
That's a great question. Start thinking about it now if you haven't already. Even if you don't expect to try and sell for, say, 3, 5 years down the road, it's always good to start preparing now. We have seen businesses sell without doing a lot of prep, but it certainly makes the process harder, and you probably get a lower value for the business. Yeah, I'll bifurcate into two processes. Some people just get approached by a buyer. Those, if the transaction goes through, it can go a little quicker, but still maybe take 3 to 4 months from the time you really get into deep discussions to get all the way to
Mm.
close. Um, the other process would be an investment banker takes you to market, trying to get a lot of private equity and maybe strategic buyers to look at you, create the bidding war, so to speak. Um, that process from engagement to with the investment banker, when you really start talking with them and to get them engaged, and it can take 6 to 9 months sometimes before all the way to get to closing. So it's a longer process. It is intense, and it can be overwhelming if you're not prepared.
Yeah, I can imagine that's quite exhausting when you're sort of discussing details every single day of the contract. But I
Yeah.
mean, thinking about it, I know I'm gonna find it hard to sell because I've got so attached to this. This has been my life for 23 years and building the brand and all the people I've worked with. Walking away is going to be hard. Do lots of people have that issue? And how do you help them go with that in the process?
Well, one of the first process or questions I always ask owners if I'm talking with them just in normal conversation, whether it's about the sale of a business directly or not, is when the time comes, you do need to make sure you're ready to sell. So, what are you going to do with your time? Some younger entrepreneurs sell and they take 6 months off, a year off, whatever it might be. Certainly, non-compete agreements can come into play, but they want to go back and do something else. It for the people that are a little bit more mature, the baby boomers. Make sure you're really ready to retire and what do you have something to do with your time if it's not the business. Um, and the emotional attachment is true. You've put your
Yeah.
life, heart, and soul into it. 23 years for you. People that spend 40 years starting a small business, growing it up. Now they've got 300 employees, and it's their baby, so to speak. Um,
Yeah,
and
it
it is
is.
a pretty
More than the babies, actually.
yeah. And the other thing to think about is, if they want you to stay on with a consulting agreement, transition period, 1 year, 2 year, whatever it might be, you're not going to have control during that time.
Yeah,
It's scary. But if you're used to calling the shots and now you don't, uh, then make sure you're ready for that as well.
yeah, that was the bit that occurred to me because it's like when chairmen retire, they can't quite let go of being chair, and they look back and think, "Oh no, I wouldn't have done it like that," and you can't help yourself. So, I mean,
Right.
basically, we're all totally unemployable. This is the problem because we try to rule the roost all the time.
Yeah, and if you are sold to a private equity or a corporate strategic buyer, and it's going to be a different structure, more hierarchy probably, and not necessarily the PE, but
Mm.
certainly if you sell to a larger corporate strategic buyer, you're going to have all the hierarchy and other things that maybe you don't like as much, and the reason you went and started your own
Tell
business.
me about it. Yeah, that's absolutely why I did it. So now this is the important bit. how do we get the best sale price? I mean, that's ultimately what we want to know. What do we need to do to get the best sale price we can for our businesses so that we can travel the world and do exciting things? So, what actions do we need to take?
Sure. And the obvious one we all think about is, more profitability and better growth creates a higher sales value, and that is true. So that's um, the on the surface easy answer. But there's some other things that you need to do to prepare. First of all, having a management team in place, um, so that the business, sometimes we call it key person risk. If an owner or a couple, three people are really driving the entire process, and they're not going to be staying, they may stay for a year after the deal or whatever. Um, that can be, detract some from value. So, you've got to think about, you've got your sales, you've got your finance, your operations, your marketing, HR, IT, all those things. You want to take a look at and evaluate it, and kind of have your ducks in a row, because that will make you more valuable to any buyer, versus them having to. They may still buy your company, but then they know they've got to put the time and effort to shoring up that team and replacing you if there's nobody to do it. Um, and that goes into their decision making process for sure. It may not be a quantitative number, but it's certainly qualitative and can affect the value. So,
Yeah, that definitely happened with some friends of mine who sold a big IT company to an Israeli, sort of cross Israeli American business, and they were tied in for a couple of years because there was really three of them that were the brains behind it.
right.
So I guess what you want to achieve is to try and replicate yourself through systems or
Yes.
however else you can do it, and by training
And
others, isn't it?
correct. And as you go, your strength may be marketing or sales or ops, and make sure that you've got the team players in where finance and the other areas where are not your strong point. Um, Yeah, and obviously that even helps before the time of the sale. If you can grow the business more if you've got that in place, because if you don't put those key people in place, then you're limited by your own capacity, so to speak.
I
Uh,
learned that early on, John. I put better people than me everywhere. 'Cause-
Hire the smartest people you can and let them do their job.
Yeah,
I'm
exactly.
plagiarizing one CEO that said that. I can't should be giving him credit, but I can't remember who it was.
Exactly. So true, though.
Yeah. And the other
Oh,
thing, a couple other things, if you're not getting your financials audited or reviewed, it certainly can help the process. Um, there's going to be some other things that are going to happen anyway. It's going to be a deep dive into your financial statements. But if you're already getting them audited or reviewed, it'll probably tighten up some of those financial controls. It'll make it a little bit better. So,
so basically, just the annual accounts aren't enough in themselves, are they? They're going to want to see more of the month by month detail,
yes, yeah,
cash
the
flow
internal
analysis.
financials
Yeah,
are very important. When we do what we call a quality of earnings engagements, they normally want at least the latest 12 months laid out monthly, if not a 2 or 3 year window of time laid out monthly, so they can understand seasonality. They can understand and if they see anything in the business cycles. And just having your financials as clean as possible helps in that regard. And it should help you, quite honestly, run your business.
yeah,
If you've got good monthly data, not just in the financial statements themselves, but depending on your industry, what we call them KPIs, key performance indicators. If you're a manufacturer, it might be throughput per man hour, and what's your scrap rate on whatever you're making. If other industries, revenue per FTE in a service business like our accounting firm. Um, the software as a service typically goes on annual recurring revenue and subscription revenue, and those type of things. So those are all important to understand your key metrics. And the other ones that affect your balance sheet, like make sure your receivable collection period is tight. You don't have a lot of old receivables. Inventory turnover is good. Those type of things. So, And having those should help you run your business even before the sale.
Yeah, no, I can see that. So when you're putting all that information together and gathering it, do you do a commentary on it as well? Is that something that you as a business valuer would do, or does the business owner help put that commentary on what's going on in those financials?
Well, and certainly it's a team effort.
Mm.
Yeah, because nobody knows the business better than the owner. They live and breathe their industry every day of their lives. We work with them to draft the language and put it in the best light when we do a business valuation. When we're doing the quality of earnings, a lot of times if we're doing working on the sell side of the transaction, the investment banker is doing a lot of the work there to really put together the the market and the business's strengths and the opportunities that are out there for the business, and that's all important for to kind of work as a team to do that and to put the business in the best light. And all businesses have weaknesses; those are going to come out, and just be prepared to address them and how you can mitigate certain issues. An example, key customers, or you may be have 2 or 3 customers that make up 30-40% of your revenue.
Yeah.
Uh, but if they're long-term customers and you've got them engaged in long-term contracts, there's a lot of things that might mitigate some of the supposed risk to buying your business.
So just going back a bit, when you're talking about the key performance indicators, which I can see would be important. Um, So if you look at a business like ours, we have quite fixed costs, really. And so our growth, like, and we were actually performing well within that. We've got our costs down and all those sorts of things. But in order to increase and scale, we need to just get more customers in. That's where our it's really going to grow. So, but that means we're actually quite a good business. But how do you show that to somebody? Because on the balance sheet, maybe your turnover isn't so high. How is that? Would you do that through your KPIs, or how do you show that vision, that future potential of the business? How do you go about doing that?
Yeah, and sometimes it depends on the engagement we're working on. But to your point, there are businesses that have high degree of fixed costs, and then there's certainly other businesses that have a fair amount of variable cost in manufacturing. So if you can understand and lay out your fixed and variable cost structure, depending on your industry, um, and your fixed costs are there. They typically stair step, but your fixed costs are going to stay flat with a certain amount of revenue growth. So that just automatically adds more value or brings more dollars to the bottom line. Um, and then at some point where you've stretched your capacity, you've got to even add more fixed costs. But that's a very good point. If you understand your fixed versus variable structure, you can show that you can add a lot of incremental profitability because your fixed costs won't go up, at least for a certain amount of revenue growth. So that's something that you can demonstrate to a potential buyer.
Right. Okay. So you would actually do some projecting, some
We
future
can do
business
that, yeah. And
plans, that sort of
sometimes
thing.
on the sell
Yeah.
side, the investment bankers are already working in that, so it really depends on the
Right.
team
Okay.
that's engaged. But if you've been approached and you don't have that type of representation, and we're helping you with the diligence, that would certainly be something we would recommend getting into.
No, that's really
So one way
interesting.
or the other, either you need to do it yourself, or somebody like us or an investment banking team needs to help you do that. So
Yeah, no, that sounds great, because what the frustration would be is that you can't show your future vision for the business, that you have it
right.
in your head. So I suppose that would be sort of future business plans as well as those actual numbers projections. It's like where you see the opportunities. So would you provide sort of the business plans you've got going forward as well?
They should, and just putting some discipline around that, typically will help owners. We see a lot of businesses that kind of think about a budget in their mind, others that are certainly more formal. My recommendation, when I was in the corporate world initially, we did 1 year detailed budget for the next year, and then we would do 4 more years, and then we cut back to saying that's a little bit too long. And so the recommendation now would be 1 year of a detailed projections with 2 more years out after that, more high level, just growth and margins. You don't need to get into every line item on the financials, but it's very helpful. One, to show a buyer, where you're taking the business, because you can bake in your new opportunities, maybe a new customer you just signed that's not in your historical results, but it's going to be in your
Right.
future
Yes.
results. Um, the other thing, it will actually just make you, in my opinion, make you think more about your business and your plan. It just kind of brings some discipline around that. Um, and certainly it's a fluid process. One thing about a plan is it never turns out exactly like that, but
Oh, I know that. I'm thinking of coach
and
now.
the forecast is not going to be right by definition. But it does. I think it allows you to pivot a little bit quicker if you need to as well.
Because you can see
And
the impact of those changes. You've worked that
correct.
out, haven't you? Yeah.
And I think buyers like it too. It shows that again, another amount of financial discipline and rigor that they see as adding value. So
And I suppose having all that detailed information and that vision of where you're going as well as what's happened and having
mhm.
I presume, a huge amount of detail in terms of what you're preparing for someone, that's going to really inspire confidence, isn't it, in a buyer?
Mhm.
Because they feel that you've actually been working properly on the business and they're not going to find any little black holes sort of hidden
Yeah.
away that nobody's addressed.
But and they all know that, no business is perfect, but to your point, you're thinking on it, you're working about it. It helps you address weaknesses, or helps you, maybe more importantly, take advantage of opportunities in the marketplace when you're thinking about them. And it also helps you maybe even manage your cost structure a little better because we all have periods where our revenue is not going up, you at a hockey stick growth. So then you've got to manage costs a little better in those type of periods. And if you've got that
Mm.
structure, you can probably do a better job of that. But again, it shows preparation, makes the buyer's life easier when they're analyzing things. Uh, it makes our life easier when we're coming into this, consult and do quality of earnings on these engagements. And some buyers will get very much under the hood if they can get to gross profit by some type of product line, or if it's a service line in a professional firm like ours. If you have different groups, what group, the profitability by group and things like that, the more they can get under the hood on those, the better off they are. So,
It's really interesting listening to you because what's really striking me from this conversation is that getting you in early is really
mhm.
the key because actually good business performance is also the same as preparing for sale.
it,
It's
it is.
it's essentially the same thing, isn't it? So if you've got somebody by your side the whole way, giving you that rigor and that discipline, then even if you're not thinking of selling, but at the moment, but you're going to sell in, say, 7 years, 8 years, when you want to retire around then. By starting that whole process now, getting some real discipline into the systems is going to set you up so well for the point where you do want to sell because most of the work's done already. Would you agree?
I would agree, and I think it will make you more profitable along the way. So you've added value for that window of time, 5, 7, 8 years. So you're going to sell for more at that time and been more profitable during that interim period. And there's an old saying: work on your succession all the time. Even if believe you're a long way from retirement, still be always thinking about who can take over the business if something happens to you. If you're a sole owner or your management team, just always be working on with the end in mind, so to speak. Um, and the more profitability you add, if it's a business that sells on, say, multiple of EBITDA, which is earnings before interest, taxes, depreciation, and amortization, and there's quite a few industries that kind of sell off a multiple of that. If you add, $1 million, or well, just even use $100,000 of EBITDA, and you sell for a multiple of 7, that's 700,000 more on the sales price. And then over time, if that 100,000 turns into a million, that's $7 million more on the sales price if it's a multiple of 7. So um, it's not only value money as you go; it's a multiplier at the end.
Yeah, it's so interesting. So how do you go about actually valuing? I mean, what are the factors in the value that people really take note of and that leads to that end figure?
And again, profitability is the number one, but there's a lot of things that go into profitability, top line sales, revenue growth, managing your cost structure, how efficient you utilize your assets, all that are part of the measurement form calculation. When we're doing what I call commercial businesses, working capital utilization is always analyzed at least monthly for the last 12 months, if not longer. So there's all those factors that come into play in adding value. So it's all those things lead to profitability. So better utilization of your assets, uh, top line revenue growth, uh, controlling your cost structure, all those drop to the bottom line, which create value. And we look at all those factors when we're valuing businesses, um, and can compare them to others in the similar with similar risk profile and same industry, whatever. If it's auto dealerships, we look at what's going on with the publicly traded auto dealerships and auto dealership transactions, for example, and how where are we at in the marketplace, and how are they valued. So we always do when we value companies, we typically always do an income approach, and then we also look at what we call the market approach, where we're looking at transactions of similar type companies. And if they're big enough to be compared to a public company, how is the public market valuing those companies in that industry? So,
Do
and
people
we try to reconcile all three of those. They should come out within a very relevant range of each other when and that's part of the process. And then we
so
reconcile those
okay.
three, those approaches to come up with the final value. Some buyers, um, strategic buyers, they may have a model in the background with their own synergies. That's something we don't know what their synergies are. We can guess, but that can come into play when you're actually selling your business. A strategic buyer or even a financial buyer that's already got a platform in your industry, they may have some synergies and some things that it's hard for us to know what they're baking into their calculations. But that comes into play as well.
Yeah, no, I have seen that where some they see the value of bolting on another business to them, and it
Yeah,
actually really increases their ability to be profitable
yeah,
and their service. So it's really valuable to them to grab those patents and bolt it onto what they're doing. No, it's,
exactly.
yeah, no, I have seen that. So, I mean, with the figures, I mean, do people sometimes get disappointed? I mean, how when you're managing the expectations of the owner, do they have to be realistic about the economy and these other factors?
They do. We see owners that maybe they have a friend or associate at the country club or whatever,
Mm.
and they know their business. It may not be exactly their industry, and they sold for a certain multiple. Uh, Number one, is it if it's not your industry, the multiple may be different. Uh, Number two, what was their company's growth rate? What were they doing? That's different than you. So just because you hear of a high multiple of a business doesn't mean that's going to apply to yours. And it's important to understand, one, what's going on in your industry. There's a lot of industries where there is a lot of activity, healthcare, biotech, although we're seeing a lot in the commercial and industrial segment this year too.
It's
Um,
good to know.
in those multiples, over time they go up and down. They've leveled off and maybe come down slightly this year compared to 2 or 3 years ago, and some of that is due to some economic concerns. Some of it's due to interest rates for buyers that will use some debt, and leverage is a little more expensive right now. Um, some of it's how competitive your process is. One thing I will say, no matter what you ultimately sell for, even if the gross number is important, make sure the net number you're going to walk away with after tax is something that you want as well. And you need to really get involved with your tax advisor, because structuring a deal from
Yeah,
a tax perspective is very important. You can give up if you do it wrong, you can give up 10 or 20% of your proceeds more than you should have with the wrong
Ouch.
structure. Yeah.
That's quite a chunk out of it,
Yeah.
isn't it? Yeah,
So the net
yeah,
number
write
is
down
what you,
tax now.
yeah, the net number is what you have to retire on, not the gross. So
Yeah,
don't forget that part.
absolutely. Uh,
Uh,
so I presume you bring a tax advisor into that team so that when you're planning that sale, you're already building that tax advice into it.
Yes, and that's another thing I would recommend, you know, if, for companies is to talk to your tax advisor, maybe even well before we're involved as the transaction goes along. Understand, work on your structure, tell your tax advisor, I'm looking at an exit event in 3 or 5 years. Uh, what do I need to do to make sure that this is structured in the best way possible from a tax perspective? Or even when you set it up at the very beginning, talk to your advisor about what's the best way to organize this. Is it a limited liability company? Is it an S corp? Um, C corps in the United States. A lot of people are not doing those unless they plan on going public, or they're going to have more than the minimum number or
Yeah.
the maximum shareholders allow for some of the others. So, uh, structure at the beginning when you create your company is important. So,
Mm.
but if you haven't already talked to your tax advisor, I would definitely, talk to them now, even if you don't think you're going to sell for 5 more years, 10 more years. Even.
So when you start on this process, just as a very brief outline, how do you start, and what are the big stages in the process?
So, when you think sit down with the owners on goals and objectives. There are some owners that all they want to do is maximize sales price, and there are others that want to make sure they sell to a buyer that will keep the employees, for example. There's some that want management to make sure that they stay in control even after, or when they sell, that the current management team stays in control. And you have to understand who the buyers are, because if you sell to a large strategic public company, they may eliminate a lot of the people. So and that may be the best sales price, but is that what you really want to have happen to your business? So we are seeing more employee stock ownership plans coming back, where the owners are actually selling to an ESOP. It's certainly not the most likely transaction, but we're seeing more of those. So one is, what are your goals and objectives? And then understand that may limit the universe of buyers, depending on what you want to have happen to the company. But after that, it's how, you certainly want to maximize the net you've walked away with. That includes the tax planning and structuring. You want to have legal counsel who does M&A work involved, because the transactions are very, very, it's a very different than just some of your regular, corporate law. So all those are part of the process. And I think getting the team in place, again, I'm harping on the same point, but 3 to 5 years in advance is very important to help you maximize
Yeah, I see.
the sale from the perspective of meeting your goals and objectives. So,
Yes, I've got a lot of work to do then, haven't I?
and I would say, to make sure that you get the best result possible,
Mm.
start as early as you can on the process. And I know that that's a point I've made more than once, but it's never too early to start planning and working on your process.
That's brilliant. I've found that so useful, John. Thank you so much. I'm gonna have to go and do some notes now and decide do a load of jobs for the team.
Yeah,
Well, get
glad,
them going on stuff. But thank you so much. And if people want to get hold of you, is the website, the Rehmann website, the best place
the
to
Rehmann
find you?
website. My email is my name, John dot, you put a period in, John dot Waybright at Rehmann.com. Rehmann is Rehmann. Certainly you can get a hold of me that way. They can also call my direct dial, which I know you laughed at last time, but that we've still got some direct dials. We're not laughed, but chuckled a little bit. So I have to look it up a little bit, because my direct dial, because I never call myself, is 407-270-3953.
And that's a US number, isn't it?
Yes,
Yeah, yeah.
it is. It's a US number. Or you can always call our Orlando office, which that I do have in mind is 407-843-4433, and they can get you patched into me. So
No, that's brilliant. Well, thanks ever so much, John, and I hope you have a good rest of the day.
you too, Becca.
See you
Thank you.
soon. Bye. Bye.
Bye.